rationalvc.com, and we have Iman looking like a hipster who's come out of the gym today. He looks like the odd one out, but you know, it's how things go sometimes. Iman?
You and Paul, you and our guest look dapper, and I just look like look at me. Like.
Well, you know, it's you belong in Shoreditch, so it's all good. So we'll get straight to it. Today's guest is someone who I have seen all over my LinkedIn for the last few years, and I'll run through the background quickly before the introduction. So, and I'll try with the Catalan pronunciation. Paul Cuatrecasas, who kicked off his career at GE Capital in the corporate finance group in New York in the late 80s. Then we'll get into this. I don't know why he left the US and came to the UK in the early 90s. He joined Aquaa Capital doing M&A advisory, a ton of roles in finance, ARC Associates, Claridge Capital. And then he was the founder and executive chairman of Allegro Capital, who are still going. They're a TMT M&A and corporate finance advisory, before launching Aquaa Partners in 2010, where he is still operating, founder and CEO, prominent player in M&A and corporate finance advisory in the technology, media, and telecommunication space. He is also the author of Go Tech or Go Extinct, which I highly advise you to all go to Amazon and order. It has 5-star ratings on Amazon, which is quite hard to come by in this category. So that should say enough for you. So yeah, I've seen a lot of his content, a lot of his comments that he leaves on LinkedIn occasionally. Very much the message is in line with our brand, what me and Iman preach. So absolute pleasure to introduce Paul. Paul, welcome to the show.
Thank you, Cyrus. Thanks very much. Good to be here.
So Paul, if we won't spend too long on it, because I know we had a quick chat yesterday, the three of us, and we got really excited and carried away. But if we can quickly just touch on your background, what brought you to London? And if you can run us through just sort of how did you get to setting up Aquaa Partners until today?
Yeah, sure. Thanks. I'll be as brief as I possibly can, because you can imagine it is a long story, but I'll make it brief. Back in 1991, when I was working in the New York office of the GE Capital Leveraged Buyout Group, we had the first credit crisis, as I call it, the first one, since leveraged buyouts were created back in the late 70s by KKR. It was the first real crisis. Prices got too high, leverage built into those high prices, and there was a blow up. And so GE Capital started to suffer from that. I could see that. I left early due to an offer that came from Arkwright, which was a Bain & Company spin out. 5 Bain partners had set it up. And I went over for an interview, and I was there a week later. Literally just packed my bags into a suitcase or a backpack, and I was in London for good, or at least for the next year or so, I thought. And it went extremely well there with Arkwright for 2 years. My boss was ex-First Boston, and we decided to become partners and set up a new firm called ARC Associates in 1993. And we went on to, this was TMT, so tech-focused M&A corporate finance firm. We ended up growing that to about 45 people over 10 years. We did deals like the buyout of Inmarsat, advising Apax and Permira. We advised many telco operators and big tech companies. And then we restructured that after the nuclear winter from 2000 to 2003, after the dot-com bust. And in 2003, I set up Allegro Capital and Claridge Capital. So Allegro was a corporate finance advisory firm. Claridge Capital was a hedge fund focused on spinoffs. I ran both of those for 3 years. And then when the tech market came back in around 05, 06, I focused exclusively on Allegro Capital, the TMT M&A shop, and then grew that effectively into Aquaa Partners in 2010 to where we are today. And, I'm still here in London because things have gone well. And when they are going well and you're running your own business, you tend not to think about going anywhere else unless it's for the business. So that's the short story.
The short story is very interesting, and let's deep dive into it a little bit. So a couple of things. Who are Aquaa, and why did you set them up?
Right. So Allegro Capital we had expanded beyond TMT. So we were doing retail, industrial, consumer. We were doing some property deals. And that's one of the reasons why we restructured that after the credit crisis in 0809, because most sectors, well, every asset class was getting killed, frankly, to that credit crisis. And I wanted to go back purely to my roots in TMT. And that was really the idea of Aquaa Partners, was to go back to pure TMT, back to the area that I knew would have phenomenal growth going forward, but I didn't know in 2010 what it would be like in 2020. So I didn't know what it would become. I mean, it was effectively a little bit more than hanging up my shingle with 5 or 6 staff that I'd taken from Allegro Capital to go pure TMT. It's really the story of what's happened in the last 5 years, because the first 5 years of Aquaa Partners were really about former relationships and clients and doing deals. And I would call it a relatively Me Too type of way, without an overarching vision and mission. And then as we were seeing changes in 2013-14, including then after the Facebook acquisition of Instagram and Google acquiring Android and acquiring YouTube, and we were seeing these platforms develop and how they would start to affect industries beyond just the media industry being disrupted. We were thinking, what about other industries? When are they going to start getting disrupted? And then it was the Walmart acquisition of Jet.com, where I say in the book, I just fell out of my chair. I couldn't believe it. And I immediately wanted to see what they were paying. They were paying a 13 times revenue multiple. So here's Walmart, a very conservative company, the largest employer in the US with 1.5 million US employees, the largest US retailer, acquiring an e-commerce company that had only been set up about 16 months earlier for $3.3 billion at a 13 times revenue multiple. And you think, I was thinking, my first reaction was, what did it take for the board directors of the company to be persuaded to pay a 13 times revenue multiple for a company that wasn't really anything like the bricks and mortar operation that they knew, which had only been set up recently? What did it take? And that fascinated me. And so it wasn't just the fact that Walmart.com as a platform really struggled to get going, and Walmart itself spent, God knows how many hundreds of millions of dollars trying to fix it, where they finally decided, you know what, this is so critical to our future that we have to do whatever it takes to get it right. And if it means paying what many would see as a premium for the very best company, e-commerce company in the country, then that's what we're going to do. And they did that. And that to me was the event, the defining event that caused us as a firm to start researching other industries and where else was this happening. And after about 3 or 4 months, we decided to start a new business around advising non-tech corporates on how to find and acquire or invest in the very best and the right tech company, the very best tech company that would allow them to fulfill their destiny over the next 10 or 20 years of evolving into a tech company, because that's where we see all industries going. And that was the beginning. And today, I guess to answer who we are today, who is Aquaa Partners, we really have a mission of creating the next generation of private equity in the context of technology companies being the ultimate lever of value, as opposed to capital or debt being an important lever of value. That's something we can talk about a bit later. The mission or the vision of Aquaa Partners is to be the go-to merchant banking advisory firm for corporate transformation in the context of contributing the best advice, guidance, capital, and talent in the best opportunities that surface. That's how I would describe what we do today.
Sure. And Paul, I'd like to consider myself a disciple of Charlie Munger and Warren Buffett. However, even I am not too fond of some of their strategies in the past decade. Now, Aquaa, you guys published a piece which is called The Death of Value Investing and the Dawn of a New Tech-Driven Investment Paradigm. Yeah. Can you maybe just touch on that a little bit, and why growth investing is that some consider the new value investing, and just go into your thoughts around value investing a little bit?
Absolutely. So Buffett and Munger are heroes of mine. I grew up reading Ben Graham and security analysis, intelligent investor, read of all of Buffett's letters, all of his work, studied under professors at Columbia who had him as a student. So he's always been in my veins. In fact, one of my favorite books is How to Be a Stock Market Genius by Joel Greenblatt, which is really based on Buffett and Graham and Dodd. So that is in my core, that's in my blood, my DNA. And the reason that we've done this research, which basically states that the old value investing is dead, in spite of my being a big believer historically in value investing, is that the world has changed. And you'll often hear many sages say, well, you can have a belief or an opinion based on certain facts, but if those facts change, then you should change your opinion or your belief. And that's what's happened. The facts are that back in 1970 and 1980, 1990, or even earlier, when these truisms of value investing were formed and developed, we didn't live in a world with the internet, with mobile phones, with the iPhone, with big data, with AI, with robotics. We didn't. We had IBM mainframes and digital computer mainframes. We had operating software. We had, in Europe, we had Scion back in 1990. But if you go back to 80, it was really the days of IBM, Intel, and Microsoft. And there wasn't a lot of other technology. We had telecom operators, but it was 2G, it was voice. And you had to dial up on a modem. So the environment of business, the environment in which companies traded goods and services didn't depend on much technology. It depended a bit on some software for some applications, but it was really limited, including word processing had taken over the typewriter. I used a typewriter. I'm old enough to remember that. Calculators as opposed to spreadsheets, and then spreadsheets came into being. We had Lotus 1, 2, 3, and then Excel. So we have to, when we make judgments and opinions, take advantage of as many perspectives as possible. And the context of value investing should take into account the perspective, the environment in which the business that one is investing in is operating in. And the environment today is completely dependent on technology. And that technology is changing, is evolving exponentially fast. And I'm sure most of the listeners here today understand the power of exponential growth. And I think it was Buffett who said the eighth wonder of the universe is the law of compounding interest, which is the same thing as exponential growth. So that's the essence of it, is change is happening so fast, but not so fast that we can see it. So grass grows quite quickly in the summer, but you can't see a blade of grass growing. It doesn't mean that it's not growing. It is growing very fast. That's why you have to cut it every few days or every week. So it really comes down to this explosion of technology everywhere into every industry. And the thing is, it's just starting. It's just starting. We've seen an explosion in the last 20 years, but it's just about to get started. Now, value investing, the concept of value investing in and of itself will never go away in the context of you want to pay a low price when you enter, and you want to be able to exit at a relatively high price. But it was Buffett who said that he'd much rather pay a fair price for a great company than a bargain price for a poor company. So that concept still applies, but it just applies in the context that the only companies we're investing in really from now on are growth companies and tech companies.
Surely the investing in any company today, as you say, has an element of tech or a reliance on tech to a certain extent. And so your ability to hedge away from tech is pretty difficult. What do you say to the naysayers or to people that will say, well, I need to hedge against this danger because we don't know if we're in an asset bubble and in 2 to 3 years or maybe 6 to 10 years, we're going to have a crash. So what are potential hedges then? So
we separate investors from, let's say, separate financial investors, which may be retail or institutional, from corporates who I consider to be investors. They're investing their capital as well as their resources. So hedging for the financial, institutional, retail investors, I would advise, would not be to invest in traditional companies that are not taking full advantage of technology to be evolving into a tech company. So Walmart, I would consider to be a company that's evolving into a tech company. GM as well. GM is invested in Cruise. It's evolving into a tech company. The vast majority of established traditional companies are not making those moves, and they're not going to be growing. Certainly not very much. These are large corporates. So if you're a $100 or $200 million revenue company, you can still grow just by taking market share and by just tactically deploying technology as a user, licensing tech. So you want to hedge if you're investing in these traditional companies in the main who are not evolving into tech companies yet. Then you want to hedge with gold. You want to hedge with real estate, property, hedge with art, hedge with cryptocurrencies, hedge with fine wine. Have a true, genuine diversification of assets that would allow for you to have a safe portfolio in the case of rapid change or disaster or something else. We know that market crashes come and go, that they're cyclical. And we know that we're going to have another market crash sometime. I think sometime soon, but we know that we're going to have another crash. If you've got a 10 or 20 year time horizon, then if you're in equities, certainly as an investor in listed equities, then you have to be invested in tech companies, in the right tech companies. And that's a basket of the 12 to 15 efficient portfolio theory companies, but they should be tech. So it's a balance of only tech companies. Now, where is another question? Would you want to be North America, Europe, or Asia? And I think this is the one thing we should look out for in the next 10 years is that while North America has clearly dominated and will continue to dominate between North America and Europe, I think Asia and China in particular is going to get interesting over the next 10 years. So I wouldn't be overly heavy in North American tech. I would consider certain China and Asian techs. And that's where I'd be invested as an investor in listed equities and probably also in private tech companies. Corporate investor, in terms of hedging, you don't really hedge apart from ensuring that you have the right execution plan after you make the investment. And I think the example I use in the book, and there's a lot of examples here, is Facebook and Instagram. And that is, Facebook knew that if it acquired Instagram at the price that it acquired it at, which I think was around $600-700 million net, that if it had really added value as even a commercial partner to Instagram for 6 to 12 months after it closed the deal, it would have increased the value of Instagram as a company so that if Facebook were either forced by the government to sell Instagram at that time, or if the board said, we changed our mind, this was the wrong deal for us, we shouldn't have bought this company, Instagram, we paid too much, whatever the reason was, then at least Facebook would be able to resell Instagram on the market at a higher price than it acquired it for and would have done well. In fact, would have made a gain as a hedge, which is not a bad place to be. So that's how I tend to look at corporate hedging, because when corporates make a move that's strategic, they should be pretty doggone certain that that's the right strategic move and that they're doing the right deal. And they've done everything possible to eliminate the risk, but also to maximize the holistic stakeholder value upside, which is quite different from financial investors in terms of hedging.
Sure. Okay. And sort of shifting gears, Paul, in your work, you've developed what you call the Techquisition plan. Can you just run us through high level what this is and why you developed the Techquisition plan?
Techquisition, in fact, it's a methodology that we created after having made the decision to form an additional business stream 3 years ago. It's a 12-step methodology. We trademarked it, and it took quite a while to put together because it's the culmination of certainly my 25, 30 years doing TMT, M&A, and capital raising, working with startups as well as corporates. And it's intended, as a company goes through these 12 steps, as an acquirer or a large corporate goes through these 12 steps, it's intended to reduce risk to the bare minimum. Ideally, eliminate risk, but you can't ever eliminate risk. So it's intended to, really the intention is to eliminate risk, if you can, by the time you close the deal, while you are also adding upside and building value, because you're getting greater with each step, you're getting greater and greater clarity, not only on the target companies you're looking at or the target company you end up investing in or acquiring, you're also getting greater clarity on your own value chain, on your own operations, on how you can techify, how you can modernize, transform, not just optimize your existing value chain. And certainly the inflection point, the part of your value chain that you're focused on with that tech company acquisition. And so by the time you've reached the end of that process, which can take from start to finish 8 to 12, 18 months, you have a deal that the board can be fairly certain has a high probability of transforming the company in some way. That's the intention of Techquisition. Low risk, very high upside, and it leads to our positioning in terms of our mission of creating this next generation of private equity based on a tech company being the ultimate lever. Because if you do Techquisition properly, which starts out with getting clarity and alignment at the executive committee level, goes through a whole discovery process, interviewing company executives, interviewing competition, looking at everything, and then searching the world, turning over every stone. It could be 50,000 companies to find that right handful of companies that you then have to do a deep dive on. And the whole thing. If you do that right, then the company that you end up acquiring or making a major strategic investment in really should be one that could transform the company. And that includes things like culture, which are intangible or they're hard to measure, but that's part of it. That's why the acquisition of a tech company can be and is for many the ultimate lever of value, because you can't buy culture. You have a company culture, and when you're making the right acquisition in the right way for the right reasons, then you, as I say in the book, you're bending your own culture to the culture that your customers want, because that's where your customers are going. Your customers don't stand still. They're not static. They're always moving, whether they know it or not. Your customers are moving with the way the world is moving and changing. When people were riding and happy and comfortable on horse and carts, and you see them in the movies, you think, well, why would they want anything else? They're happy telling jokes in their horse and cart. They don't know anything else. And they see the automobile come. They're like, I like that. That's fast. It's quick. And it's different. And it's going to be getting us what we want in a better way. Faster, easier, cheaper, safer, maybe safer. In the early days, maybe not. But that is what this is all about. So when you're acquiring the right company, you're bending your culture to that new company that's already figured out what the next great thing is going to be. And they've got customers and they're excited by it. And they tend to have some of the best talent, in the world that does that thing. And when you're partnering, acquiring that company to become part of the family, then, at the bare minimum, you have a type of osmosis. You're going to be picking up on that, that techification, whatever you would call it. You're going to be picking up on that vibe, that DNA of that target company. And if you do it really right, and I'd say the example that I give here is McDonald's acquiring Dynamic Yield for $300 million in 2019, where the global chief information officer, Daniel Henry of McDonald's, said, look, it's not just for the technology, the platform, the solution of Dynamic Yield that we want. It's the people, it's the data scientists that come with the company that will allow us, McDonald's, to go faster than we could ever go on our own. And it was the same thing with Walmart and Jet.com, the same thing with GM and Cruise. GM acquired Cruise Automation for about $600 million, zero revenue software company in March 2016. And, GM got a lot of slack for that. Why are you paying $600 million cash for this company that who knows if it's going to do anything 10 years from now with self-driving vehicles? Well, it was announced yesterday that Microsoft is investing $2 billion into Cruise at a $30 billion valuation, because Cruise has gone from 40 employees at the time of acquisition to 2,000 today, some of the best engineers and data scientists in the world around self-driving technology. Why? Because at the time, GM, Mary Barra, to her credit, had vision for their company in the next 10 years. And they concluded in 2000, probably 14, 15, before they did the deal in 16, 10 years from now, all vehicles that come off the factory floor will be self-driving electric vehicles. And that's like going from horse and cart to the automobile, because the automobile or the vehicle itself will not need to look like the vehicle today, because you won't have a driver, you won't have the steering wheel. You don't have, the windshield can be a movie screen. Total game changer. And they executed on that vision in a similar way that Walmart did. And that culture, the reason I'm bringing it up on the culture point, it was so strong at Cruise that I call that deal a reverse acquisition. Even though they paid $600 million when GM's market cap was about $45 billion, it was a reverse deal from a culture point of view. And this was validated or solidified when Dan Amon, the number 2 of GM, became the CEO of Cruise, I think in November 2018. And the Cruise executives were like, great. It's not that we're no longer running the company. They became chief evangelist officer or chief technical. But now with Dan Iman, who's I think the number two, he was the number 2 president of GM, becoming CEO of Cruise, there's a much greater likelihood that our technology will be on millions and millions of vehicles. And that's really all we ever wanted, was that our idea, our dream, our work, our blood, sweat, and tears would be materialized into millions of people's lives. And that's the most exciting thing for any entrepreneur. And guess what the shareholders of GM get? They get a higher share price. They get value creation because GM took a very strong point of view, made that investment, and they've built on it ever since. And so everybody's happy. That's the true win-win.
The combination of a strategic reasoning for an acquisition, in addition to the value you get from the cultural acquisition from the company that is acquired, plus the flexibility of your own culture within the business to accommodate for that, is all really interesting. But there's a bit in your book where you talk about mindset in particular. And I feel like mindset, especially from the executive level, drives a lot of those things. So can you just explain a bit more about how mindset enables that traditional business to pivot?
Sure. It drives everything. Mindset drives everything. Walmart, Doug McMillon, CEO, absolute right mindset. Otherwise, it would have never been approved by the board, the Jet.com acquisition. And Doug said it 2019. He said in an interview that I saw on CNBC, he said, we could go away overnight. And it reminded me of Andy Grove saying only the paranoid survive. So it was this mindset that the most successful have of paranoia. It doesn't matter if you are number one, Intel with 80% market share, Walmart, number one by far, Amazon, yes, on its tails, but Walmart is still the big kahuna in the US of retail, but paranoid. And Mary Barra, CEO of GM, paranoid. GM's number one in the US in automotive, but she knows it's temporary and they will be disrupted out of existence unless they make the move. So the mindset is that it doesn't matter where we are today, whether we're number one market share, whether we're growing revenue and growing our profits and margins, doesn't matter. We could be number 2, number 3, doesn't matter. The mindset is we are going to do the right thing in terms of adjusting our business to where the puck is going. And we're not just going to talk about it. We're not just going to read about it. We're not just going to sit on panels and say, oh, yes, we're doing more technology and we're optimizing, because that doesn't get you very far. I mentioned in a webinar I did recently for Columbia alumni, it was last month, the case of Henkel, which is this German personal care laundry detergent products company, I think with 45 billion euros of revenue. And in 2016, they made statements that they would be optimizing and even using the word transforming their product portfolio. Very interesting. But if you look at the performance since that statement was made by the company, it's just been downhill. And the reason is they haven't executed. Now, they may argue with this, and that'd be an interesting argument. But they haven't executed on the vision or on the statement of transformation in the way that others, like I've mentioned, have. And that's because this term transformation is used very loosely. I don't even like to use it anymore because it's becoming a buzzword that just sets people off in a negative way. Probably 80% of the people who use that term digital transformation don't even know what they're referring to. Transformation is the frog turning into the prince. It's the fire-breathing dragon emerging from the cave that had a lizard in it before. Transformation is what it means. Look it up in the dictionary. It's a total change in the way the company thinks, acts, behaves, or a human. Take your pick on the subject. But I don't think companies should be using that term digital transformation lightly. I think they can say optimization, they can use innovation, we're improving. The problem is that today every company is innovating. Every company is improving and optimizing. Every company has access to Microsoft, to Google, to IBM, to EMC. They have access to all of these incredible number of VC-backed Series A, B, C, D software companies, AI companies that are doing amazing things. I mean, it's really very exciting. in terms of the incredible ingenuity that's expressed in some of these tech companies that are growing and being funded. But here's the thing. If you're an established company, a non-tech company, your competition has access to all of those in the same way that you do. So what are you going to do that's truly different? If you're a food company, for example, you can do what you've always done, which is maybe decrease the size of the chocolate in your chocolate bar or have a new color or a new range. That's only going to get you so far. Kraft Heinz, by the way, has tried that and has been doing that and probably do it very well. But what's happened to their share price in the last 4 or 5 years? Down significantly. There's been shareholder value destruction. Part of it, yes, is due to the heavy leverage and they're cutting costs. They're cutting costs in the wrong way. But where is the transformation? Doesn't exist. And so that's why I believe the only way now, and it's taken me a few years to come to this conclusion, a few years of working with a lot of corporate clients and working with them to achieve these goals, as well as having discussions with now over 400 companies at C-suite level about this theme. I have personally concluded, based on the facts that I know today, doesn't mean they won't change, in the future, but that I don't see how any non-tech company can transform and ultimately even survive to the satisfaction of their stakeholders unless they're deploying some form of inorganic move in tech, whether that's a full acquisition, whether it's a strategic investment, whether it's an exclusive partnership with the right company. And that doesn't mean CVC. It does not mean corporate venture capital. Most companies who are not tech do not do corporate venture capital the right way. I think Google and Intel and Microsoft, tech companies, I think they do it very well. They know exactly what they're doing. You'd expect them to know exactly what they're doing, and they do it well, and they do it as they should be doing it. But most non-tech corporates who set up a corporate venture capital arm, they don't really know what they're doing. Boy, I'll get all kinds of flack for that because, of course, all the professionals in CVC today are saying, that I'm off my rocker and I don't know what I'm talking about because I'm not a CVC executive. The fact is that look at most of the companies, and I'm not including the ones who are doing techquisition extremely well, like GM, like Walmart, like McDonald's, like Lululemon. The list goes on. There are many companies who are doing it very well. Those CVC arms are there. They know why. Those companies know why they have a CVC arm because they're doing everything well. A Walmart does organic in-house innovation very well, hires great talent. They file for patents. They have a CVC arm. They have an incubator accelerator, and they do full techquisitions. But most of the non-tech companies who set up the CVC arm, it's sometimes lip service. It's sometimes to allow the executive committee to say, well, yeah, technology, we have a team that does that. And why are those investments made? Well, so we can learn, so we can be in the market, so we can, all that is good. There's nothing wrong with it, but it's not going to move the needle. It's not going to lead to transformation. It's not going to lead to market leadership, market share leadership. It's not going to lead to the customer being delighted with the experience they're getting, like Amazon does every single day. So, I've covered a lot of ground there, but I really believe that that the only way today for a company to get to where it needs to get to based on stakeholder expectations is to execute some kind of techquisition strategy.
Yeah, that was one of the questions, and you've pretty much answered it. So, and I actually totally agree with your comments regarding quote unquote digital transformation, as I feel like this is especially thrown about lightly in large corporates where managers who have no skin in the game just sort of use these terms very lightly. Will firms in the finance space, such as Aquaa, also go extinct if they don't invest in tech? What is the future of finance in your view?
So interesting question. FinTech's huge. There's 50, 60,000 FinTech companies. Most of those companies are operating on the periphery of existing processes today. So we're not seeing deep transformational change yet in FinTech, which would really be around digital assets and new protocols like blockchain and so on. That's coming. And there, of course, there are FinTech companies today who are executing solutions around that. Of course there are, but the vast majority are, around payment tech, payment solutions. Sometimes you'll see banking tech that are back office. But really your questions around our type of business, which is really focused on making judgments and assessments and then executing those judgments into events, are very much human. I think we can be informed by AI and machine learning, and we're doing that. And I think most of our competition, if they're not doing it, they're thinking about it. Absolutely. We will be as technology enabled as we can be, but ultimately we'll be 80-20 rule, 80% driven by humans. And I think that's true. And in terms of, if you ask me where I see all companies going 10 or 20 years from now, 20 years from now, maybe not so much 10, although we'll see, it's exponential, it could be 10, is that most companies will have fewer employees, but the employees who are left will be very top heavy because they're the ones designing the systems that are executed by machines, whether they're physical or software, robots, AI. The vast majority of companies will be automated. They will be automated, not because of fear of viruses and coronavirus, that kind of thing. They'll be automated because they can be and they should be, because businesses have, since they started in 5000 BC, have always been focused on one thing: optimization and improving and growing and getting higher margins. And so automation allows for that. And because we have this exponential pace of change in technology and in the world, we're going to see companies with fewer employees and designed by the smartest humans at the very top. And for finance, all the companies today that are dependent on humans at a mid-level to low level will experience true disruption. And either they choose to embrace it and take advantage of it and transform, or they will suffer from it. And they'll either have to exit or they will go extinct. And that is true for the larger financial services firms. It's true for asset management firms that depend on humans instead of bots. There's no question. I mean, I don't even think any of that's a secret. I think most people would agree that it will happen. The question is when. Will it be a year, 2 years, 5 years? But businesses like ours, I don't see changing much. I do see venture capital firms. There are some emerging that are pure bots, AI machines that are searching for the very best companies. That's interesting. And I would say that's a tool. So if I had a pure VC firm doing Series A investments, for example, or earlier stage, I would try to build or buy the best AI machine I could to inform my decisions, but I wouldn't absolutely rely on that. I think it's way too early for that.
There's a really interesting point with VC, which is VC isn't so much about the strong diligence, the due diligence that we can do at the later stage. It's fundamentally comes back to the mentality point, and trying to figure out the people that are setting up these companies. Are they the right people that will win in the longer term? And we talk about this in previous episodes. We talk about how VC is a dartboard game, right? You chuck 1 million darts at a dartboard and hope one sticks that returns the outsized returns.
And it shouldn't be that. I've lived long enough now to have a point of view on this. And I've dealt with thousands of VCs over the years on hundreds, if not thousands of deals. And I've come to believe today that the highest probability of success in early stage companies come from leaders, the founders, who are completely driven, even drooling, to achieve their mission, which typically has nothing to do with money. They have an idea, they have a vision due to great frustration or due to opportunity that has just slapped them in the face. And once they take that step that an entrepreneur takes, which is extremely high risk, then the ones who take a deep breath and go all in and can get and take 20 hits and 30 hits and 40 hits and go down, down, down and get back up again and again and again and again. And they get up without any impact on their ego. That is just, hey, it's me. I made that decision to be an entrepreneur. And so it's all self-inflicted pain. There's no one to blame but me. And if I get hit, I get hit. It's no big deal because I'm just going to get right back up again. And they do it over and over again. But while they're doing that, they're able to have great respect for their investors. So it's not their own money. They may start with their own blood, sweat, and tears and money. But as soon as they take in money, they become a risk manager. So we tell our clients who we choose to help raise capital that they should think of themselves as a risk manager because they're taking someone else's money. And their job is to say to that investor, Mr. Investor, it's your money now, it's your money later. It's always your money. It's never our money. We're a custodian for your money, but our job is to give you back your money plus a lot more. And that's it. We know that, and we want you to know that we know that. And if the entrepreneur behaves that way, while they are also taking great risk and executing with energy, and which is critical, huge energy and passion, and the ability to remain egoless as they're being slapped, over and over again every day by people who don't believe them or don't want them or turn them down, you got a winner, because they will figure out a way. They know that because they don't bring ego into it, their idea has to be the idea that wins at the end of the day. They're not overly stubborn. They're willing to. It's frankly one reason why we called our firm Aquaa Partners with the extra A, so that we're not pure water, but we're close to water. We're like water. Water is the source of life. Water boils, it freezes, it moves around, it goes through cracks, it goes to where it needs to go to. And the very best entrepreneurs will do whatever it takes. It's why I think you'll probably ask me who's my favorite, entrepreneur. It's why Jeff Bezos is my favorite entrepreneur, because for a simple reason. He says every day is day one at Amazon. It doesn't matter if we're a $2 trillion company. It doesn't matter that we started with a piddly little website that looked like crap, frankly, to sell books. And today we're one of the largest retailers in the world. And by the way, we're not just a retailer, right? We do a lot of other things in finance and so on, and health. And it's that mentality of we are always starting. We're always seeing things new from a fresh perspective. We're always taking risk. And in Amazon's case, we are always focused on the customer. The customer is all that really matters, because if we are making the customer happy, really happy, then we're doing our job and we'll always do well. And so I kind of smile when I see the government, different governments who look to regulate these companies and split them up. And by the way, I've said, if they do split them up, it doesn't matter. Look at eBay splitting up PayPal, which they acquired very successfully for whatever it was, $1.5 billion in 2002 or so. Then they spun it out for $45 billion. And there's a lot of talk, well, okay, PayPal's on its own now. It's not going to do so well without eBay. Well, look, it's a $260 billion company today. So Amazon focusing on the customer and giving that customer what they want and what they don't even know what they want in an experience that is just a total delight, they're going to win. And so that's the spirit that you look for in entrepreneurs who are clear, they are sane in terms of their mental health to a certain extent. They know what they're doing, why they're doing it. They know how to do it. And if they don't know how to do it, it doesn't matter, because the how will come. I believe passionately in that. And I just see it every day in all types of companies. And, it's unfortunate sometimes you meet an entrepreneur that has everything but that. And it's quite frustrating, because you think, you're onto something really good here, but all the things that you really should have, they're not really there. And that's where it gets challenging. That's really a challenge.
Yeah, totally agree. So Paul, touching on sort of your personal investment approach, what do you personally look for, let's say, when investing? Like, what constitutes a good company for you, whether it's quantitative, qualitative? I mean, you've already touched on the founder aspect, which is crucial in my view. And then just sort of a follow on any sort of frameworks or mental models that you use as an investor that help you with decision making in the process.
Yeah. So as an investor, you're absolutely right about the management team. They have to have that X factor that I described to give a high probability for the company to have its success. And one of the reasons for that is being able to attract the right people. The entrepreneur that has that X factor that I described will attract the team that he or she needs. And the team is everything. It's never one person. There was a great interview that Steve Jobs and Bill Gates did on the stage of, the name escapes me now. I think it was 6-7 years ago. And they both said very honestly, very clearly, that it wasn't because of us. It was because we both have great teams. We've got the best teams in the world. So it's the founders who attract those teams. That's critical. And you've got to be able to see that and judge that. Then you want to look for the obvious things, which is, I call it traction, because if a company doesn't yet have enough revenue or profit, some companies can be loss-making for years, like Amazon was for loss-making for many, many years. So you want to see traction in the form of customer love, whether it's, and B2B is different from B2C, but you want to see evidence that people who are using the product or the solution or the service love it. And they wouldn't know what to do without it, or they would really feel like, I mean, can you imagine today if we didn't have Amazon, if you're living in a country where Amazon is good and you've got Prime and you've got same or next day delivery, take Amazon away. Oh my God. It's like, what am I going to do? Because we've become dependent on Amazon, especially in the pandemic. So I look for that factor. What is the love factor of a company's product, service, or solution? And that can be gauged by very careful calculation of KPIs. Some companies try to try to hide. Sometimes it's not done deliberately, but the KPIs can tell a white lie. You got to be very careful in how you look at the data and that it's high quality data. But testimonials and comments and sharing, if it's a B2C offering and it's something that could be shared on any kind of social media, then not just how it's being shared, but what are they saying? What are people saying about it? And how are they sharing it? That's just critical. If it's B2B, then you really need to look for early customers or would-be customers and what they believe about it, what they say about it, and why, and what is the special sauce. And then if that's the case, is this special sauce protected? Is it intellectual property that can be protected, patented? Or is it know-how and trade secrets that are so difficult to reproduce that you've got an edge, at least of 2 or 3 years before anyone else, or that you could patent? So I want to say those things first before big market, because most people say, oh, it's got to be a big market. It's big market. It's extremely helpful to have a big market, but you don't have to start with a big market. I don't know the full story of Facebook, but I don't know if when Zuckerberg started Facebook or whatever it was called before it was called Facebook, which was for Harvard and then Ivy League and then for universities, et cetera. Did he start out thinking that this is going to take over the world? Or did he start out thinking this is going to be a cool way to meet chicks at my college and other colleges? Okay, I don't know. That's a B2C play. On B2B, you start, I go back in time now to GM and EDS. So EDS, IT services company, very good one at that, founded by Ross Perot, within GM. And it was so good that GM just gave EDS as an in-house division, more and more business. But EDS was so good that it started contracting external clients as a systems integrator. And it was so good at that it spun out of GM. So in that case, it was, what's the external validation that an in-house unit, IT unit, is so good that other companies are saying, we can't find anything else in the market that's as good as your GM's unit. Can we sign up with EDS? So those are the things that I think are important to look for. And if you do something in that product, service, or solution that is so good and so powerful, and you've got the right team, which includes the ability to imagine possibilities, and you can code those possibilities or code them into an integrated circuit, if not through software or platform, then you can move into adjacent markets, and you can expand and extend and then grow and become that much, much larger company over time. And I think that's the thing that investors take for granted and they're not that aware of. I gave Amazon an example. I'm going to just put another name out there, and this is just an idea, not that it's going to happen. It's an example of an idea. So food is, don't get me started on food. It's my most exciting industry because it is huge, multi-trillion-dollar global industry that's going to be completely transformed in the next 10 or 20 years, like the horse and cart was transformed by the automobile. And I mean at every part of the value chain, from the actual, cattle, the cow and the pig and so on, going to the lab and to plant, all the way to drones delivering our meals to us in 10 minutes. So if we look at food, we look at a company, HelloFresh, that's a meal kit company that's got a number one position in the market. And 2, 3, 4 years ago, investors were poo-pooing meal kits. It's broken, fragmented industry, doesn't make any money. It's got bad unit economics. HelloFresh starts to gain momentum going into the pandemic. Of course, now benefiting widely from the pandemic. Its market cap is $11 billion. And it's gone like a exponential curve. Now, if you go to the website and you see what management is saying, they're saying, we want to take advantage of this $1 trillion market. We want to be a major player. I can't even paraphrase it because it's been a while, but I can tell you that what they say about their market opportunity combined with their track record would lead an investor to believe, maybe not at these price perfection at the moment, but would lead an investor to believe this is a company that is thinking very big and very broadly and very widely, and that over time, they wouldn't necessarily try to do everything in-house. And if they find a way to expand in an adjacent market through an acquisition, through a techquisition, then why wouldn't they do that? And I think that's something we should start looking for in tech companies that are the new tech, not the old Google, Apple, Amazon type of tech. I think that's pretty exciting to me. We've already seen it. We've even seen it in lab meat, which hasn't been improved anywhere but Singapore yet. There's certain lab meat companies who are acquiring other lab meat companies because that in itself is an exciting and major engineering challenge. And if you see a gap that you need and you can't buy it, you can't find the talent or the science to fix it, but another company has figured it out, well, then you do a deal with that other company. I think we're going to see a lot of that.
That is very interesting, and I think I want to continue this conversation, but I'm cognizant we don't have much time left. So I'm gonna move the conversation on a little bit onto yourself, how you've got to today, etc. And I think a telling point of all the people that we talk to is what are their top 3 favorite books. Now you've talked about the Buffett books, but do you have any other 3 books that are your top 3 that have shaped your life?
It's funny because for our offsite meeting we had about 2 or 3 weeks ago, I had a list of about 40 books that I put on the end of the agenda just to say, I started out with 2 or 3 and it went to 40 pretty quickly. I'm a voracious reader, so it's kind of hard to come up with just 3, but
putting you on the spot.
Yeah, that's okay. So for investing, I don't want to start with the obvious security analysis or the intelligent investor because, if you're investing, you just have to read those books. You got to know the basics. I would say How to Be a Stock Market Genius by Joel Greenblatt, because he builds on that value investing principle in a way that allows investors to have an edge from special situations, from spin-offs, from split-offs, from leverage recaps. Some of that is a little bit less relevant today, but I'd say 70-80% of it. I think the book's about 10 or 15 years old. Greenblatt, by the way, has been an extremely successful hedge fund investor and extremely credible and to be respected. So, that book was an eye-opener for me from an investment point of view. From a business point of view, I started out loving the In Search of Excellence and the Tom Peters books. I read them all. The one, looking at the last 20 years, modern era that had an impact on me, even to the day, I still mention it a lot, is Built to Last by Jim Collins. And of course, we know Jim wrote Good to Great, which I also love. But Built to Last had an impact on me because of the description of culture and described the power of culture on stakeholders. And he tells a great story of Hewlett and Packard and how they started. And of course, probably half the companies that were, quote, built to last are no longer around, whether it's Motorola, I think was one, and HP, which destroyed itself by acquiring Compaq. It was the wrong deal to do. But a great book and had a real impact on me. Then the other one I think I'd say, which really influenced me to get to where I am today. So from the Built to Last culture, business perspective to Techquisition and where I see the next 10 years and where I am more excited than I've ever been in business by far, is The Singularity is Near by Ray Kurzweil. That inspired the Singularity University. Obviously, he and Peter Diamandis hooked up and created that university. But the book gives the full argument with evidence as to why he believes today I think it would be 12 years from today, 12 to 15 years from today, we'll be at the singularity, which is where human intelligence is kind of the Turing machine, machine intelligence greater than human intelligence. And then what? Then it's a little bit hard to predict what happens. We're probably not as far away from quantum computing as we think we are. Some say 5 years, 10 years. If it's 5 or 10, it's soon. And quantum is going to change everything, but singularity is the big one. And so we're on that last stretch. And I'd say and that's my I guess my third book out of all of them, because I'd say to young people, as I do today, think hard about what you want to do if it's business as opposed to politics or academia or something like that, although I say this would equally apply. With a movie, The Graduate, the statement I think Dustin Hoffman gave to the elder gave to Dustin Hoffman was plastics. You don't want to be in plastics today, right? Today, you want to be in exponential technology. And the next 10 years might be all that we really have in taking advantage of the incredible disruption, 12, maybe call it 15 years, the incredible disruption that we are going to see. And that we can't even imagine yet. I mean, even the telecom operators who are launching 5G, Verizon, AT&T, Telenor and the others, they are, they're the experts in 5G, along with the equipment providers like Huawei and NSN and so on. But even they will say, we don't know what's going to bring with 5G, and that's new types of AR and VR and holograms, and it's extremely exciting. And it's exciting for so many people in so many ways. And I'd say if you're a young person today, you really want to be interested in technology, even if you love metals and mining, you love natural resources, even if you love oil and gas, that's okay. But if you're going into oil and gas, go in for how it's going to have to change to renewable sources of energy, and go into that with a technology hat on. Go in with how you can make a major impact on that industry, because the industry as we know it is effectively dead. So it's for any student going in to do anything in the next 10 to 15 years, technology is really the sole focus. And that's what I would, coming back to the 3 books, that's what I would say as an interpretation, those 3.
Yeah, what a great way to end. Paul, I've really enjoyed this conversation. Wealth of knowledge. So, ladies and gents, go tech or go extinct. Please go and order it from Amazon right now. We will put the link in the show notes, and also the link for Aquaa Partners as well. If you're a CEO and you want to reach Paul for his wisdom or their expertise in the business, then please do reach out. Any final remarks, Paul?
No, just thank you, Cyrus and Iman, for this conversation. It's been very interesting.
Thank you for coming on, Paul.
Appreciate it.
Absolute pleasure. Thank you so much, ladies and gents. Paul Cuatrecasas.